Creditinfo provided two sets of capabilities that were on the supplier side that I was interested. Where is the source of this data? What can you understand more about behaviors of this customer on the data? What else can you give the solutions? The way MSMEs work today, they slip money through their mattress, so they don't bank everything, so you don't get as much behavioral information. And the way they run their business is more of from an expert point of view, but at times they don't go depth to understand whether they can grow the business beyond themselves as a succession. One of the things I have seen the financial teams, financial industry struggling is how do they deal with a customer who's a thin file client. But that thin file, think about today, we are growing a lot of people coming out from universities. They are not necessarily getting white collar jobs, but they are getting into the gig economy.
Correct.
So as they get into the gig economy, you find the way they get their money is more of a day to day. They do a gig today and then they earn today, but they will not land that money into the bank. I think digital lending will cease to be a product. It will be embedded. It will be in your lifestyle. It will be BNPL. I walk into a store, I want to buy this, I want cart and I buy. Now, when you think about in the Western world, a lot of this happens on your credit card. You have a credit profile, it's embedded on your credit card. But in this market, we are so heavy on mobile. AI, they say AI is getting integrated into what we do, but it's not going to be really a disruption. The people who change are those people who use AI, not they will be replaced. For me, how do we take satellite data? They tell us about the quality of the soil, they tell us the quality of the farm, and then extrapolate that into the bureau data or the aggregated data that gives you a credit profile of the person.
Good morning, good afternoon, and good evening, and welcome to another edition of the Pure Digital Passion Podcast with me, Moses Kemibaro. My guest today is Michael Nyaga, who is currently serving as the regional consultant for East and Southern Africa at Creditinfo Kenya. He has over 2 decades of experience leading digital lending innovations at top-tier banks such as Equity Bank Group and also I&M Bank. Thank you for joining us, Michael.
Thank you, Moses. How are you?
I'm good. How are you?
Good.
Good to have you on the pod finally.
Thank you very much. Looking forward for the conversation.
So, Michael, you have a long experience and there's many things that you've done across financial services. But I'd like you maybe to give us a bit of flavor, your origin story, so to speak, your background and how you ended up here at Creditinfo.
So my background, I started as a teller.
Oh, really? In
I
a
was
bank?
a bank teller, and that was about 2003, sometime in August. Got trained as an economist, a financial guy, then got into banking, and I was this very excited guy. But then what I got into was where I worked was not very well structured in terms of how you go about business, but then evolved in it. I found myself into credit 6 months later. And what I was doing there was largely about financing in the rural setup. So I started my career in Kerugoya branch.
Wow.
Out of Nairobi. I had never gone beyond Thika.
No way.
So
Until that point.
I was very scared and I was wondering, okay, where am I going? But then that's where my career started. I started at Equity Building Society then. So ground up, went up the ranks and ended up in my last assignment as the group head of bureau for Equity. But along the way, what really changed me is getting into the consumer banking space. And in the consumer banking space, it was very manual. A lot of transformation happened. Got into when computerization was happening in the organization, and then did a lot of manual work in terms of how customers used to borrow. But then it started triggering to me, okay, you're starting to attract a very young population. You think you want to scale, but then your processes are extremely manual. In the process, I got assigned a role where we needed to decongest our branches. And I remember one branch I went to, 2 branches actually. I went to Naivasha branch and I went to Eldoret branch. And when you walked in there, it was dark. not dark because the structure was wrong, but the people in there
The number
made
of
the
humans
place, the
there.
number of humans.
Wow.
So that made me think, okay, let's think about why do customers walk into the branch? What do they do? Okay, yes, they want to do cash in, cash out, but then there's on the credit side, which was my space, I realized that they wanted to borrow what do we call overdrafts, short-term overdrafts. When the salary is coming in, they want to get paid. So Naivasha, because of the flower farms, Eldoret also because there was a lot of transition into rural and urban migration into Eldoret, and there was a lot of that. So my first transition into digitization was to automate access to the product on the ATM, because that's the only digital platform we had at the time.
This is all pre-M-Pesa and all that stuff.
Pre-M-Pesa. So we got in there, and from the time we launched into the 2 months later, branches started becoming brighter because people are not
the humans are now at the ATM.
Yeah.
Okay.
And then fast forward, then we came into 2014, 2013 when we launched the first MVNO platform, and that's where now we got the SIM card to now get customers' credentials. And now customers started using the phone other than going to the ATM. And then there was a transition from the ATM into the mobile. And to me, that was a transformation to lending. And that's how I got into the digitization space, but from consumer banking into technology. I've
So
never
you moved
done
from really the manual and gradually tech all the way across, yeah?
Correct.
But all of this was ultimately driven around making credit available.
Correct. We had a very rudimental way of assigning limits, policy rules. Before even we started talking about credit scoring coming in there, but there were just rules. Okay, how many times you get paid? How consistent is your salary? When was the last payment you got? What is the value? Then you assign a limit and put it at static for about 2-3 months. But then there was no behavioral in terms of changes that can happen. So there was some level of credit risk that you are still accommodating. But the volumes and the kind of revenue outweighed the risks. And that's how I started seeing this potential in growing into that space.
Wow.
Yeah.
So you got into the technology side and all these things pretty much by the fact that there was this evolution of how credit was actually handled.
Exactly. And I think that opened doors to largely financial inclusion, because then we started segmenting clients into, you have customers who are they are paid twice a month. There are those ones who are paid once a month. There are those ones who are paid contracts for 3 months. How do you think? So then we started getting into credit scoring in a rudimental way to try get some level of behavioral understanding of these customers and give them longer. The lending was still very short term, 1 month, 1 month, 1 month. Others, then we started going into 14 days loans and the like. And then by the time I was leaving, I think we were doing about 10 billion shillings in Kenya every month. That was it. Then an opportunity opened up to go and set up retail banking for I&M.
So tell me about your time at I&M and what it is that you did there.
So I&M is predominantly a corporate bank, was a predominant corporate bank, but before 2000 and, sorry about that, and before 2022, because that's when I went into that. And getting into the space, what they wanted to do is to create a retail bank, but because they don't have the footprint like a retail bank has, they wanted to automate it.
Okay.
So the origination has to be automated, decisioning has to be automated, and that allowed us to create that space. So I got into there, created the framework for them, created the first product. I think we were in ground up in 7 months, we're into market. And that changed. With that time I got in there, the transition, the lending decision was 2 weeks.
Wow.
To get a personal loan.
Okay.
That transitioned into 10 minutes.
Wow.
And that was transformation from that. We had not even gone into doing that on the mobile. We had to first proof the concept by doing it in the branches, but in an automated way. So there's a credit scoring behind the scenes, but you have a UI that is available for the users in the branches to make a decision quickly.
Okay.
Because they had centralized all the lending decisions, but then the customers are not centralized. They are decentralized. How do you make that experience good enough for them? So that's largely how I got into I&M.
Okay.
But then Later on, the opportunity to serve the group in equity came about, and I went back.
You boomerang.
Yeah, it was an interesting because by the time I was living equity, that time it was largely Kenya. And then I went into taking care of the 6 countries, DRC. DRC was exciting because it was new, it's greenfield. It was
And
new.
equity acquired 2 banks there and merged them, right?
The first point of entry of it was Pro Credit, and then later on BCDC came on board. BCDC is the oldest bank in there. It was largely a corporate bank. So there were merging conversations there that are a transition that we had, but the bigger opportunity in there is access to credit. The penetration in DRC today, we are talking about, when we went there, it was about 4%. A year ago, that has ramped up to about 8% financial inclusion. If we compare that to what we have in Kenya, we're in the upwards of 90%. So there's a lot of headroom to grow into that particular space. So that's what now gave me, I saw the opportunity as a bigger one to scale up what we've done in Kenya into the other regions and grow that particular space. Yeah.
Okay, so tell us what happens from there to get to Creditinfo.
So Creditinfo, interesting transition, because for a long time in my career I have been on the demand side.
Okay.
And on the demand side here, you're transitioning what you're creating, and you're seeing real consumption of what you're creating on the other side. But behind the scenes, you realize there are very many enablers, and enablers where there are data sources for you.
Yeah.
There are enablers who provide technology solutions for you. There are enablers who provide the skill sets around credit scoring. And then now I got interested because Creditinfo provided 2 sets of capabilities that were on the supply side that I was interested. Where is the source of this data? What can you understand more about behaviors of this customer on the data? What else can you give the solutions? The banks I worked with were more mature. You want to start seeing how does this solution get, can you put it in a larger scale to the other banking industry, to bigger industry, and also the kind of interaction I saw Creditinfo having were beyond the banking industry, which kind of interested me into so it's been a good transition. Last 6 months has been pretty exciting for me, learning how to be on the other side of the table, being a supplier, and also having to now speak about the solution and how it translates into value for the consumer who is not largely playing on the demand side. That for me has been transformational for me.
So given that I think right now you're sort of in the data and driving impact through data, what's the relationship between the psychometric scoring, alternative data, and also credit worthiness? It seems to me that these are areas that you spend some time kind of understanding and materializing into sort of the products and solutions that you're bringing to the marketplace.
So if I start with psychometric, my first encounter with psychometric credit scoring was when you're trying to do something for MSME. And the target clientele were customers who we had we can call them thin clients. You have very minimal information. The way MSMEs work today, they slip money through their mattress, so they don't bank everything. So you don't get as much behavioral information. And the way they run their business is more of from an expert point of view, but at times they don't go depth to understand whether they can grow the business beyond themselves as a succession. So we worked with Entrepreneur Finance Lab at some point on using the understanding on how the behaviors, how do they make decisions, how do they go about challenges and opportunities that come their way as they navigate the new business that they are in. Then you're able to know whether this person has the willingness to pay. Psychometric, to a large extent, will largely speak about the character of the individual, because little does it have into financial. But then coupling that to the alternative data sources, because alternative data sources for me would more go into unstructured kind of data. We deal with a lot of structured data in the financial space. But when you go into the unstructured data, then you start getting insights around how does this customer behaves. Probably it's Android transaction data. You want to scrape some information about their SMS transaction. What does that tell you about this customer? They will tell you now about their ability, but how do you couple that together with the willingness to pay? Today, you have many people who have ability to pay, but they don't want to pay. in some various corners that we have that. So you want to couple that, especially when you're dealing with MSMEs, they tend to want to move to another opportunity that they see that takes away the capital away from the business. But the psychometric analysis will help you unpack that. And then you filter into, you couple that together with the financial transaction. So bringing that together, that would help you now to make the worthy creditness of a customer very well in terms of the affordability and the character that you have. And that provides you with a good sense of who is this a good credit person to back your money on. And that to me is what I would see as an opportunity for us. Even as we get into data sources that provides that, then we aggregate that with the bureau data that we have, that provides a very wholesome view of our customer, a 360 view, and provide them that.
So going on from that point, therefore, how does Creditinfo use this information, this data and the insights to enable financial inclusion in the marketplace as far as your services are concerned?
One of the things I have seen the financial teams, financial industry struggling is how do they deal with a customer who's a thin file client? But that thin file, think about today, we are growing a lot of people coming out from universities. They are not necessarily getting white collar jobs, but they are getting into the gig economy.
Correct.
So as they get into the gig economy, you find the way they get their money is more of a day to day. They do a gig today and then they earn today, but they will not land that money into the bank.
Yeah.
But when you engage with them and you give them some of these tools, then you're able to see their financial transactions that come through their mobile phones that go to up. You will start seeing transactions of how they handle their money and how do they take the short-term credit and pay.
Yeah.
If you couple that and have a unified view of these customers from the data that is submitted to the bureau, that provides a very good entry point to another lender who wants to attract this customer, call it like a bridging financing.
Correct.
And bring them. It's like you're front loading a lot of the information that they never had into their space and they're able to lend to them. So that to me is what I see as more impactful for the financial industry, getting them to see the other side of what information they don't have. They only see what is within their ecosystem.
Okay.
How do we showcase to them that these solutions that we create based on the information that is submitted to us helps them to add value into their particular space? And that is what I find more impactful from a Creditinfo point of view to any lender that will be speaking to in their boardrooms, in their conversations with their RMs, and transitioning that. And you might find use cases of this kind of data going into servicing, because some of them go into even educating, some filter into what you call financial literacy, the kind of information. You find customers who maybe they are first time of default is this because probably they diverted funds. How do you use that information to bring them up to speed on how they manage their finances better and they become a credit fit customer in the future? So those are the solutions that we scouting about and seeing how do externalize them to the customer.
I think that's brilliant. So what you're saying is that you might have instances of customers who, of course, these defaults might happen for whatever reason.
Yeah.
But you're also then able to go back and find ways to educate them or guide them to be more responsible, loanees, as it were. Yeah.
Exactly.
Fantastic. So we have this new proposition that you're launching today, the KYC proposition. I'd like to know more about what it means, why Creditinfo is launching it, how it fits in with your work with other financial institutions. What is the significance of this proposition for Creditinfo?
So we've been studying the data quite a bit, and one of the things that has come out is that we can use various trends to proxy an outcome that is coming in. Well, for example, if I pick one use case like the first payment default, if you track one lender and you keep seeing 1 month, second month, third month, fourth month,
there's
a trend. This customer doesn't pay their loan. So that can be deemed to be something happened to that customer. So it requires you to check. But then how do we correlate that trend with other financial data that we see or other demographic information that we see? Demographic information could be like their age, could be also there are some other static information like their cell phone numbers, their ID numbers. We could also start seeing about their email addresses and how they are. Now, they say lending goes wrong at the point of appraisal. And I'll take it a step further. Lending goes wrong at the point of onboarding.
Even earlier.
So if you don't do a good job and bringing the customer on board and know that this is a customer who has a character. Remember we talked about character initially. They say, I remember we used to talk about the 5 C's of lending, when one of the first one is character. I could have a good ability, but this customer, if they are not giving you rightful information, then that gives you potentially higher NPLs down the road. So you find that you're writing off maybe your repayment rates. If you're a digital lender, your repayment rates are in the 60% repayment rate, and you have a huge 40% loss rate. How do you manage that? How do you manage that in terms of even the funding that you're getting? You'll be out of business very quickly. So for us, we're looking at this as an opportunity to safeguard the financial institution from that loss that may come their way down the road, and make sure that even as we couple that together with the financial standing of the individual, whether you're dealing with a thin client or a customer who's moving from lender to lender, then you're able to correlate that with the kind of information they provide to you. Whether that information is recent, that information is consistent with their profiles, and that allows us to enrich our offering to the customer. Beyond the credit models and assessment, we also tell them about who this customer, how fit that customer is. And that's how I think we'll be looking to engage the financial institutions around.
So going forward, what kind of onboarding experiences will this enable for both the people who are applying for them and also for the financial institution that is looking to onboard those customers?
So today when I see the onboarding process, mostly you find that there's a lot of data. The customer journey has some level of friction, either because you're asking the customer, apply, attach this, attach that. So what we're trying to do is to ask you to provide very few input fields. And then what we have orchestrated at the back aggregates into very many data points that we have at the back to give you a one single view. So I don't have to ask you as a lender to integrate multiple APIs to us. I want you to have one unified API that gives you all the view that you want to see at a point and make a decision. And that decision can be yes, no, maybe. And then you can decide whether that maybe transitions into a back office that you need a bit more of check, or you want to straight through accept the customer and make the onboarding process as seamless. So our intention is not really to make any process as to make the pain point more for the onboarding. We want to establish that it's going to be a very seamless process, because we want you to only consume one API, not multiple APIs.
Correct.
So even beyond making, as much as we are safeguarding the organization, we want to make sure that even as we safeguard you, we make sure that the customers who are coming, they don't feel that pressure, and make you have as many customers onboarded as possible. That's what we are intending to achieve with them.
So from your perspective, and also from a Creditinfo perspective, what can one expect in terms of the next iterations of digital lending? What are the things that we can expect going forward?
I think digital lending will cease to be a product. It will be embedded. It will be in your lifestyle. It will be BNPL. I walk into a store, I want to buy this, I want cart, and I buy. Now, when you think about in the Western world, a lot of this happens on your credit card. You have a credit profile, it's embedded on your credit card. But in this market, we are so heavy on mobile. We are so heavy on technology. And you'll start seeing that even as you look at the median age of the people in this country, especially now, I've seen we have ramped up to 20. So I think we are becoming an aging population, but still young. But those kind of customers don't want to have a friction of, oh, you want this, I want this fridge, I don't want, okay, go and see this bank, and then you come back when you get. They want to go in there and say, I want this fridge, okay, can I get it on credit? I want to pay in bits and small pieces, walk out. That retailer should have like an endpoint where they call, get your credit profile, and work as facilitate for you. They have a partnership, a collaboration with a lender, and that lender manages the credit. But you as a as a retailer facilitates the sale for you, and you go. So you have an auto pay kind of capability to pay to the retailer, but the lender stays with the account. So for me, I see lending should now start focusing on people who do not want to have an interruption of their lifestyle. I used to have a mantra that says, "Bank is where what you do, not where you go." So the lending also should not be where you go; it's what you do, because you do it every single day seamlessly. I want to see an agriculture customer who is, how do we use the data we get, whether from off-takers, aggregators of agriculture information, that reduces the need for collateral, because agriculture is a very seasonal kind of a product. But it doesn't mean that we cannot digitize that, because AI, they say AI is getting integrated into what we do, but it's not going to be really a disruption. The people who change are those people who use AI, not they will be replaced. For me, how do we take satellite data? They tell us about the quality of the soil, they tell us the quality of the farm, and then extrapolate that into the bureau data or the aggregated data that gives you a credit profile of the person. If I'm able to have behavioral information from an aggregator who's in agri, beyond giving me the soil and the area that you're planting information, how do I know the historical outcomes of what you've planted in the past?
Wow.
And I assign a limit to you, and I structure a funding that is principal plus interest over 3 months, because you will have to have 3 months, and I have like a ballpark number that I ask from you after 3 months. So that's, to me, the future. I start seeing there will be a lot of blockchain usage. There's one unit I think will be disrupted in the financial sector on trade finance, because today we have a lot of cross-border trading. We have a lot of people who are buying things offshore. I was just telling someone the other day, I bought a shoe somewhere outside the country, assuming I didn't have a credit card. But assuming that credit card is not powered by a capability to know how to lend to it. So think about the same way. I want to buy a bulk shipment of item, but that item will not be shipped if I don't give a letter of credit.
Correct.
How do I use blockchain technology to allow the guy to ship in the data, but I pay in bits and pieces to my lender locally? So those are the kind of technology things that I start seeing that digital lending will be. But most importantly, digital lending will cease to be a product. It is going to be a lifestyle. It is going to be buy now, pay later mechanisms that will be employed that allow you to start shaping a cash economy into something that generates a lot of value for MSMEs. Because today I want an MSME to start creating ecosystems that says, I want to see my customer here, I want to see the son of my customer and the like. And you start creating that ecosystem, but it's all powered by ability to borrow and pay in bits and pieces, but in a responsible way. There will be a lot of intentional lending.
Yes.
So things like embedded finance. When I want to, what do you want to buy? You want to buy a car. I want to borrow and pay for that car immediately, so that I don't divert funds. That allows that there's no diversion of funds, and you can be able to track that customer actually was financed for a vehicle, as long as I've done a good sense. Today, you find even corporate lenders. Today, they will be disrupted by AI, because I cannot have a corporate lender who sits in there to analyze a file. I'll run a file through a statement, an OCR reader gets into an algorithm that gives me analysis of ratios and everything else. I assign a limit to that corporate. A disbursement happens. The only other thing that I need to deal with is, if it's collateralized, how do I use blockchains to deal with say registries that register that collateral and mark it in the interest of the lender. There will be a lot of it. So digital lending, to me, is not going to be a product that is deemed to be the masses for the lower bottom of the pyramid people. It's a lifestyle that will be embedded across the financial chain that we will be dealing with. So that's my view. of how I see 10 years from now on how things will evolve. And AI will really disrupt a lot of things that you say. Today, you want to buy a car, but one of the consideration is that you want an insurance premium financing. Why should I have two-step stage? Why can't I have one? Seamless journey that integrates money that goes to the underwriter, money goes to the bank, and money goes to the buyer of the vehicle. And I am the only one who facilitates that, but I have one single view, and that all goes into my profile. So I think that's the future I see for digital lending.
What I'm hearing you say, which I think is incredible, is that we're moving into a space where it's all going to be based on data, fully integrated in an ecosystem where all the players are seamlessly providing whatever is required.
Exactly.
And down to the retailer, down to whatever it is that you're trying to do.
And regulation will have to play a lot of catch-up because there will be a lot of integration. So today, when you think about this country, a lot of the lenders who are regulated are people who are maybe in the banking space, or people now digital lenders now also, to a large extent, borrowing into the banking regulation.
Yes.
I think we need to have like a credit act that says every single lender has to submit data somewhere centrally. Now, what does that provide? It provides a good view of everything, because like today you could be in business, you have a credit line with a supplier, your distributor, or your manufacturer. That kind of trade kind of line does not find its way into the bureau, but you're a credit provider as a manufacturer. So I would reduce issues to do with overfunding and making sure that you have the true net worth and true value of that person, and there will be very little default, if any, if we have to go that way. That's largely what that embedding into the lifestyle allows for that space to happen.
Wow. And then lastly, what do you think Kenyan institutions can do to better use data to serve the unserved or the underserved?
I think to a large extent is similar to what we discussed about agriculture. I feel agriculture and the lower MSMEs are little underserved because they're not very well understood. And if organizations would start adopting technologies that provide them with information that is right for filtering out a credit fit profile and understanding the cycles of the people who are in that particular space. And today I like looking at agriculture, unpack agriculture into many things, unpack agriculture into livestock. Livestock today, you can actually buy livestock, supply it to people who are exporting it. Either you are a farmer themselves and you have capacity to do that, but you're still able to generate revenue. How do I go into an aggregator who sees your transactions? And I'm able to filter that information, and I'm able to make a lending decision for you, automate it, and make it easy for you to access any funding. Maybe probably, it depends on what role I'm playing in that particular space. Either I'm the manufacturer of that whatever, or I am the person who is a middleman.
Okay.
If I'm the middleman, I need financing to go and buy.
Yes.
That, because probably I have access to capital, I have transport in my space. I can be able to make sure this guy keeps producing more as I keep transferring to my external market. So for me, I think what we need to have is a situation where the data that the financiers use is allowing to get people who are largely outside the financial space.
Yeah.
And also people who are in agri, especially value chains like I am doing avocados, I'm doing potatoes. How do I understand your cycles? What kind of kilos do you produce? How do I make sure that comes out into a lending of farm input? But I structure your financing in a way that is very centric to how your cycles are. Today you have MSMEs who are doing businesses, but they borrow from a shop. But that shop is carrying a load that doesn't belong to them. The financing needs to go to the lender. How do I empower the lender to have access to this data of what happens in that trading space and provide lending to the people who keep coming back to them? And for him, he offloads that capital and does more. And then leave the retailer to keep selling to the end consumer and paying back his debt and keep the cycle going. That filters a lot of manufacturing, filters a lot of the value chain that you have to display. And that's how banks should start using data more than a gut feel kind of. And it saves them a lot of cost, because you will deal with aggregators that, as opposed to chasing one individual permit. And that allows you to even scale your level of funding.
Fantastic. Michael, thank you so much for this conversation. I think the way you've unpacked some of these insights, especially like the agriculture one, I love it. And also the way you pointed out that it's not going to be a product, it's going to be a lifestyle.
It is.
I think that is really impressive in terms of, I'm so excited about what sort of possibilities that will open up for the marketplace.
Yeah.
And thank you so much for being on the podcast.
Thank you for having me, Moses. I appreciate and everything that we've discussed about. Looking forward to greater partnerships.
Excellent.
Thank you.
So there you have it. Michael has really, I think, taken a lot of time here to really unpack the scenario as far as what Creditinfo is launching today in terms of their new KYC product, but also I think giving us newer perspectives or different perspectives around how the whole credit space is playing out based on his long history, but also going forward, what this might look like in the future for all the different stakeholders. Thank you for joining us for this conversation, and we definitely hope to catch you in the next one.